What's good, everybody? It's Jonah. Come back at another video. So for this video, I'm going to do the recap for Thursday, July 30, 2026. Now, just letting you guys know in advance, this is a non-trading day. So whenever you see in the title of the video it says NT, that basically means that it is a no trading day. So I did not take a trade on this day. Now, I was also not behind the charts on this day because, like I mentioned in my previous video, if we go to the news, right, on Forex Factory, you see that Wednesday was FOMC. So my rule of thumb is the day of FOMC or any days that follow FOMC, like follow after FOMC for that week, I do not trade. And usually FOMC falls on a Wednesday. So after FOMC, right, the Thursday and the Friday, I'm not behind the charts. I'm not actively trading. On this day, I did not trade. And it's usually because, the morning of FOMC is usually not a setup or price typically consolidates before the actual, massive rally. And as you can see, right, this big bullish candle was when FOMC started, right? Price rallied up and then it aggressively pushed all the way down. So you see that price did this, went up and then went straight down. And same idea for the NAS, right? You see this bullish rally up aggressively and then this aggressive bearish candle lower, right? So this is a major news event that I stay away from, right? A lot of gamblers love to trade this. I don't. I'm here in the markets for the long haul, so I'm not gonna gamble my account or gamble any of this stuff, right? Like I'm not going to be in the markets during that event. So because this move is so large, you're seeing that it's taking out traders on both sides, right? Traders who are both bullish and bearish are getting taken out. This is why you hear that, the 90-90-90 rule, that 90% of traders lose 90% of their money within the first 90 days, right? Because you're seeing the market play both sides. The market with the NAS came up here, right, and cleared, activated buy stops, right? And any traders who seen this and thought price would break out started buying. Um, they obviously got taken out with that move right here. And then after traders enter for a buy, price immediately reversed against them. And then what happened? Price came up here and activated what? Sell stops, right? A lot of sell side liquidity because there's a lot of traders down here who expect that if price goes on this level, that price is now officially bearish to continue going down. They were in profit a little bit with this move, and then you're seeing prices reversing again, right? So this is the game that's being played with price, and that's why I stay clear from all this. And usually with FOMC is usually a long, like a large range, and then after that the market is kind of like moving slower because it's like slowly inching its way up, kind of like consolidating, right? So that's the logic there. However, we're just gonna jump in to do the recap, right? So we see that on Thursday you had some news at 8:30, right? So that's all we had to really worry about here. So now jumping right in, only 1 hour time frame, we determine the higher time frame buys. So this one is pretty straightforward, right? You can see price came down, cleared this low with this push right here, and then after FOMC, right, this low got taken out with this push here. Now, prior to this push, this is the most recent swing point prior to that low, which obviously price is nowhere near this high, nor did it ever go near this low, right? So price is bearish on the S&P, and the same idea with the NAS, right? You're seeing that even though this price came up and cleared this high, price aggressively pushed down, broke structure down here with this low. Now obviously you have this low right here, and this was the previous swing point prior to this low. Now price is within this range from this low to this high, and price is right in the middle. So we can expect, well, price is bearish, right? Because it's in this range, and it's unlikely for price to make its way up and break structure prior to 8:30, right? Because this candle closed here, this is 8 o'clock, right? So we can expect, the buys to be bearish. Now, jumping in, we'll skip to 8:45, right? So we can have a clear view of the 8:30 candle, right? So this candle right here, this is the 8:15 to 8:30 candle. So if we look to the left, we want to highlight the most recent swing high because we're bearish, right? So we want to see a high get taken out. We want to see price go up into, some sort of previous high, clear it, and then we want to take price lower, right? Same idea with the NAS, right? We want a previous high. I mean, this one's already taken out, but like some sort of previous high, right? To get taken out, we want price to go above it and then shoot down, right? So for the S&P, this is 8:30, so we look to the left. These do not count because they are equal highs, so we cannot use that. And obviously this high was clearly taken out a while ago, So we have to keep looking back. And the most recent swing point is this high right here. Now, when you think about it, price is working between this high and this low, and price is almost like around the middle. And so it is, just looking at it right now, right? It is very unlikely that price is going to make its way up here before, allowing us to trade so that we can take price all the way down, right? Very unlikely that it will happen. However, that is the bias that we have. We are bearish. So that is what we marked as our liquidity pool. Now, since we're bearish, right, we want to mark our targets. So just marking a few obvious targets on the way down, right? So you have the lowest low of structure on the 1 hour, right? Because if price is bearish, you would anticipate this low to get taken, right? For structure to continue heading in the right direction. Have the London lows here, another London low there, and then you have some of the session low forming. Same idea if we look at the NAS, right? So this bearish candle here that you're seeing, that is the candle that ends 8:15 to 8:30. Now, this candle, obviously takes out this high, right? And it doesn't make a swing at all. So we have to look to the left. So the most obvious one would be all the way up here, right? So this is our liquidity, right? So we're seeing that the peak of, like, if we look at the high, right, of these candles, right? This is the high of the FOMC move, right? So we're effectively expecting price to go up to that level, which is unlikely, right? And then you want to mark down your targets to the downside, right? So you have a low right here, right? And then you have the London lows because London is the green background, and then you have the actual lows, right? So this is pretty much what I'm looking for with my trade idea, right? And then, after price forms a little bit, you can try to mark the low of the session as another target, right? So this is effectively what I'm looking at right now with this setup. So remember, right? Once again, I'm not trading on this day. However, we do not do anything unless price reaches our point of interest, which is our liquidity, right? And so we literally have to just be super patient, right? Because price is far away from everything. So now I'm just gonna press play to see what happens, right? And you're seeing prices sort of consolidating. It's traveling a little bit in no man's land, right? You can see, like, with the NAS, prices slowly inching its way up, and the same with the S&P. You're seeing a little rally, you see a high get taken, but once again, it's not near our point of interest, so we have to just keep watching price. All right, and then the next candle will be the 9:30 open. So 9:30 open opened bearish for the S&P and also opened bearish for the NAS. So not necessarily ideal because, once again, I mean, yeah, we're bearish on price and we want to see price push up. So to have an opening that's bearish, not necessarily ideal. It's not the end of the world, but we're still expecting that big push up, not because we're bullish, but because we expect price to want to hunt at the liquidity. So now, right, we can mark the lows of the session, right? So this right here would be the lowest point of the session, and we could, I mean, this is technically the lowest point, but you can move it back here, right? Because for a lot of traders, this is quote unquote support, or a double, if not quadruple top. I mean, sorry, a quadruple bottom, right? So a lot of traders are buying here, right, to take price higher, right, because they see that as support. And the same idea with the NAS, right? Like this low right here, this is the low of the session, right? Because it's the lowest point in the brown. And then you're also seeing right here, what is this? This is quote unquote support or quote unquote double bottom, right? So traders are buying here, it's generating liquidity. We're already seeing that, and these could also serve as targets as well, right? So now we'll just continue pressing play to see what happens. And so now you're seeing now, right, a few minutes go by, prices are sort of like ranging a little bit, and then now you're seeing aggressive bullishness. At least with the S&P, you see this lower push, cleared some lows here, cleared the low here, right, before now it's doing a rally. Now for the NAS, right, this wick here clears some liquidity, but now you're seeing price push up. And why? You're expecting price to push up because it wants to go to this level up here. So yeah, and S&P is still very far, right? So the NAS is obviously a lot closer. So my attention is pretty much on the NAS, right? And so as I keep fast forwarding, boom, right? You see here at 950, we're seeing at 950, that's when price poked into the liquidity. So now when I see a liquidity grab, the next thing that immediately goes to my mind is the previous structure point. So you see that this is the new high that got formed. So prior to this high, where is the most recent swing point? Now, if you're quick to point it out, right, the most recent swing point prior to this high is in fact down here. So this is not necessarily ideal for a trade because price, even though per liquidity, as at this point, as currently constructed, right, price would have to go all the way down here to then be considered a structure break, right? And then obviously that would be a mass, potentially a large stop loss. And so I'm looking at this right now and I'm thinking to myself, okay, I want to see another push higher, right? I want to see this high get taken and I want to see another push higher so that price can do this and leave a new um swing low, right? Because I want to see a new swing low, so then when price goes down, it breaks the swing low and then it allows us to take an entry, right? So we can take the entry there and then push down, right? I'm sorry, it's not the best drawing, but that is what I'm thinking, right? Because we want to see a break of structure, and if the last point of structure is all the way down here, that is going to be a very horrible setup as far as risk reward, as far as like everything, right? So, and it's probably not even going to deliver us a setup because we want to see displacement. So displacement would basically mean consecutive bearish candles. After this first bearish candle got formed, you would need to see consecutive bearish candles all the way down here, which is very unlikely to happen, right? So in my mind, I'm expecting price, if it's going to give us an entry, it needs to push up. Now, of course, price went up, right? And price made this new high. So prior to this new high that was formed, where's the most recent swing low? Obviously, you have it right here, right? So I can now push this right here, right? And you just want to stalk price, right? And what I'm doing is I'm basically planning in advance, right? Like, this is the beauty of knowing what it is that you're looking for when you're showing up behind the charts, because then it makes your life so much easier, right? Because you know what you're looking for, it's clear in your mind, and so you're not confused, you're not worried, you just have a clear mind as far as like what is it you're looking for, and either price is going to give you what you're looking for, or you're just not going to trade and you're just going to walk away. Once again, I didn't trade on this day because it's still after the FOMC. I'm just giving you guys the breakdown so you guys can see, if you decide to show up on this day, how this process would be if you were using my strategy, right? So then what happens here, right? Of course, this black candle makes the highest high, right? Obviously, this still remains as the previous swing point prior to the high. Now, after the black candle form, you see a bullish candle formed right after. That means there is no displacement. So if price were to go down afterwards, it would still, it wouldn't fit my confirmation because displacement needs to be consecutive candles. So because this happened here, I'm already waiting for price to want to make another push higher, right? Because at this point, if I go on the 2 minute time frame, right, you're seeing that on the 2 minute time frame, there's no swing point. This swing point only exists on the 1 minute time frame. So that means if you don't see it on the 2 minute, you're not going to see it on the 3, 4, 5 minute. So right now, the only opportunity, if a setup were to present itself, would only be on the 1 minute time frame because there is a swing low that is available to be broken. Right. So now pushing up, right? So this high now gets taken with this push up here. Now, what is prior to this move? What is the most recent swing point? It's right here, right? So what we do is we now move this right here, and so we're basically just stalking price to see if price is going to give us a break of structure with displacement so that we can take an entry if we were trading on this day. And now if we look at the S&P, S&P still in the middle, point of interest at the top. So it's unlikely that price is going to go up here. It can, but it's unlikely that it will, right? But most of my attention right now, I'm entirely focused on the NAS because NAS already reached our point of interest, where S&P, it still has, right? It still has a long way to go between here and up here, right? So I'm not interested in whatsoever, right? Now we're going candle by candle. We're just watching price candle by candle. Boom, right? You're seeing a new high, right? This is the new highest high gets formed. Now, of course, this is still the most previous swing low. So this doesn't change. However, you see the bearish candle and then you see a bullish candle, which means that if price went under and broke this level, it would not count as displacement, so I wouldn't take a trade because I need to see consecutive bearish candles. So I'm effectively looking for price to now clear this high again and make a new high. And you're seeing, right? Once again, this is the highest high that got formed, and it was formed with a bearish candle. Then right next to the bearish candle, you're seeing right here a bullish candle, a gold candle. So because you have the high that create the bearish candle, and then you have a bullish candle and then bearish candles, to me this would not qualify as displacement. Now if I go on a 2 minute time frame, you're seeing there's still no structure. There's no swing point on a 2 minute, 3 minute, 4 minute. It's only a swing point on the 1 minute. So effectively I'm only looking at price on the 1 minute because that would be the only time frame where there would be a legitimate structure break. Now of course you're seeing a fair value gap be formed here, but this is the most recent structure point that price would need to break. But even if it does, once again, would not count as displacement because you have this gold candle that interrupted the aggressive move down. I'm looking for the swing point prior to the highest move, right? I'm not looking at this swing point. I'm looking at this one here. So then if we continue on, you're seeing, right, what happens with price. Price is what? It breaks structure, right? You see it clear as day. Price went under this low here, but what did I just stated? Because this high was formed and it was a bearish candle, but you've seen a bullish candle in between, it ruined the entire momentum of this. So to me, this does not count as displacement. So I'm not, even though, right, you see a fair value gap that got left in a range, right? Because usually the next step, if there was displacement, right, you will look at the displacement range, and right, this would be the displacement range is typically from the low to the high, right? The low to the high prior to the break of structure, right? After liquidity gap and then a break of structure, you look at the range from the low, right? The low to the high. And then within this range, do you see any fair value gaps? Yes, we do. We see a gap here, right? We see another gap here, and then we see another gap here, right? So we're seeing 3 fair value gaps that fall within this range. And if you think about it logically, right, the most the highest probability fair value gap for price to tap is this fair value gap down here because this is at the bottom, and in order for price to ever reach this fair value gap, it needs to tap this one and then this one, right? So logically this would be the most, high probable entry because I mean it'll give you the worst stop loss, but you get the idea, right? Price will have to tap into that first. However, this does not fit my confirmation because of this one candle right here. So I look at this break of structure, but I do absolutely nothing. Absolutely nothing, right? If I go on a 2 minute time frame, you're seeing there's no swing point. There's no swing point to be broken, right? The on the 2 minute time frame, the most recent swing point is down here. So price would have to make its way from at the top all the way down here in order for there to be a structure break on the 2 minute. So that's why I'm not looking at the 2 minute. I'm strictly on the 1 minute. And because like I mentioned, it doesn't complete my definition of displacement, there is no trade. So at this point, right, this is what I'm looking for. Waiting for price to make another push above, because if it does not fit my confirmation, I do not trade, and I wait for price to make another push above, hoping that it fills my confirmation to give me an entry, so then I can take price lower. And this is the level of discipline and patience you need to have as a trader, right? You need to be clear in your mind on what you're looking for so that you don't make these mistakes, right? Because you're going to see what happens, right? You see price breaks lower, and then what happens here, right? You're seeing this gap get filled in, right? Price taps it. So if I were to be trading on this day, which of course I wasn't, right? And I didn't pay attention to this candle, you know, many traders would have entered here, right? Obviously, price came into here and would have tapped the other entry, and then you see what ends up happening. Boom. So if you were looking to go short at any one of these levels, stop loss above here and then take profit down here, right? Obviously, price tapped into this fair value gap too, right? And then clearly price just went up and blasted through, right? So price didn't respect it. So this is the point of having rules. You want to have rules that make sense, rules that are logical, that you can follow, so that the point of rules is so that it can help you succeed, right? So now you see that price went above this high with this bullish move here. So now initially, right, at first I'm seeing this being the highest high. So where is the most recent swing point prior to this high, right? It is right here, right? Because obviously it makes a U, right? Because candle to the left and candle to the right are higher, right? So what I do is I move this right here, right? So this lets me know that this is the previous swing point. Now, of course, this high gets taken out with this candle right here, right? Now, prior to this move here, which is the most recent swing point, obviously it's down here, right? So then I move this right here, and you effectively continue stalking price and watching it until it potentially gives you what you're looking for. Now, sometimes I also check the other time frames to see, right? So on a 2 minute time frame, you're seeing that this is in fact a swing low, right, on 2 minute, and then this is also a swing low down here, and then obviously down here, right? So these are the swing lows on the 2 minutes, right, and might be on the other time frame, but right now I'm watching price on the 1 minute time frame to see what it does, right? So okay, so remember this wick right here, this made the high, and then after that you see a gold candle, okay, no big deal, and then you see the first bearish candle after the high is made. So because you're seeing a bearish candle here, this is the first bearish candle. Now I need to see every candle after this bearish candle be consecutive bearish candles to push under here and leave a fair value gap in order for this to be a legitimate setup. Otherwise, if it's ever interrupted with a bullish candle or gold candle, I need to see another push higher. So then you're seeing, right, 3 consecutive bearish candles and then a bullish candle. So this already has no displacement. So I wouldn't take any sort of setup. And there's obviously no fair value gap, right? So I'm just waiting for price to make another push above this high again. And this is how you gotta like treat trading. Are you seeing prices just consolidating, right? This is literally a consolidation. This is still the highest high, and this is still the swing point. So I'm just waiting for price to ideally push up, make another high before doing anything else. Well, let me specify this on the 1 minute time frame, because obviously things can potentially look different on a higher time frame, right? And I will show you guys. So on the 1 minute time frame, this was the high. You're seeing a lot of gold candles. Now price obviously broke the low, but there's no displacement on this time frame because you're seeing a lot of gold candles that unfolded here. So I would not be looking like on the 1 minute time frame, there's nothing. However, if you want a 2 minute time frame, right? This is why you want to check the time frames, right? If you want a 2 minute time frame, um, you're seeing that this high got formed, and then you're seeing bearish candle, but then you also see bullish candles with it. So there will be no entry on the 2 minute time frame. And now if we look on a 3 minute time frame, right? 3 minute time frame, this swing point does not hold, right? Because this is obviously not a swing point. So the 3 minute time frame, the most recent swing point is down here. So 3 minutes, right? This is what we're looking at. However, you're seeing after the first bearish candle form, 2 more bullish candles form. So that would not classify as displacement in my eyes. So then 4 minute time frame, right? The same idea here. This candle was the high that was formed, and then this is obviously the most recent swing. You have after one bearish candle form, you have a bullish candle right there. So that's not displacement. Already ruled out. Now in the 5 minute time frame, now you're seeing on the 5 minute time frame this high, right, bullish candle. Then you're seeing a bearish candle, and then another bearish candle. And then on the 5 minute time frame, this is not the swing point, right? The 5 minute time frame, this is the swing low that we see on the 5 minute time frame. So you're seeing the logic how I begin ruling out all the time frames. So pretty much where it all stands right now, the 5 minute time frame would be the only time frame that can potentially, obviously price would have to continue going down lower and deliver me nothing but consecutive bearish candles. But on the 5 minute time frame, if that were to present itself, this would be the only legitimate time frame for me to take a setup. because 1 minute time frame, all the other time frames didn't have displacement. So now we went to the 5 minute time frame. So now this 5 minute candle formed, another bearish candle, right? You're seeing multiple bearish candles and then you're seeing a fair value gap form, right? However, we're still not under the low. So until we break this level, we're probably going to continue to remain bullish. Then boom, you see this aggressive. I'll I'll um I'll full screen it because nothing ever happens with the S&P, right? So you see this move right here, right? If I put a trend line, you see that it gets broken, right? So price does in fact break this low, right? And you're seeing aggressiveness. This is what I'm referring to with displacement. This is what I want to see. However, one thing to remember is that my trading window is from 9:30 to 11 a.m. Eastern. Now this bearish candle right here, this candle is from 10:50 to 10:55. So when this candle closed like this, obviously this low traded through this low. So this counts as a break of structure. However, because this candle went down and when it closed, it was at 9:55, I knew that there wouldn't be a trade because if you think about it logically, the next candle that forms, which would be like a candle right here, this would have to be the candle to like provide a wick to then create the fair value gap. Why? Because a fair value gap is a 3 candle pattern formation, right? You have the wick or the low of this candle and the wick and the high of this candle, and then the gap that forms is what creates the fair value gap, right? The space in between. So fair value gaps need 3 candles to form: one candle, one candle, two candle, three. It's 10:55 and we're on the 5 minute time frame. So the next candle that were to close and form would make it 11 o'clock. So even if there is a fair value gap and a legitimate entry, I knew that I still wouldn't trade it because any opportunity that if price were to tap my entry, it would happen after 11, which would break my rules. And this is the level of discipline you need to have as a trader, right? So you see here, this is the candle that went from 10:55 to 11, and you're seeing clear as day, it left a fair value gap. So when I'm talking about displacement, I'm referring to price. Once like the first bearish candle forms, you want to see every candle be consecutive bearish until the structure break. Now, obviously, a clear structure, and then now you're seeing a bullish candle. So to me, this still works. This fits my confirmation perfectly. However, this candle right here, when it closed and left the fair value gap, it is already now 11 a.m. So I no longer trade. Right. So this would have potentially been the entry. Now, if we go into the, you know, into the other, like in the back in the 1 minute time frame, you're seeing that this is a candle from 11 a.m. to 11:01. So obviously it didn't tap into fair value gap, but the fair value gap gets tapped in at 11:03, 11:04. So once again, I didn't trade on this day because it's the end of FOMC week, so I'm not behind the charts. But you can see price does in fact tap into the fair value gap. Long story short, it would have resulted in a loss. You see price taps it, price moves down a little bit, price taps the fair value gap again, but then price eventually goes in the opposite direction, and then it would have resulted in a loss, obviously, because you would have shorted right here, stop loss above the high, and then you would have been taken out, right? So this is the reason why you need to have rules and confirmation, right? Because the rules and the strategies and everything that I use, right, it has very strict rules, but the point of these rules are to protect you. They're to save you. They're so that you can avoid unnecessary trades or low probability trades and unnecessary setups and unnecessary losses, right? This is why my strategy is time based, is from 9:30 a.m. to 11 a.m. If I am not in a trade before or by 11 a.m., that's it. I walk away. I'm done. It doesn't matter what it looks like, right? Obviously, you can see this setup was forming perfectly because this is what we're looking for: a liquidity grab and then displacement, a fair value gap within the displacement range from the low to the high, right? You see this fair value gap forms in that range, and it gave us perfect entry. But once again, it's after our trading window, so we do not touch it. So even if I was behind the charts looking to trade, there wouldn't have been a trade for me to take. And this is what you need to have. You need to have a strategy that is very logical. And the reason why I'm giving you the breakdown on this is because, right, if you watch my videos from even like 2 weeks ago, a week ago or 2 weeks ago, you would have noticed that I would have taken a trade right here, right? That I would have um taken a short at this point. Why? Because I'm bearish, and you see price came and cleared liquidity, and then it left a bearish fair value gap. But the problem with taking this trade was that there's no break of structure. Price never broke any structure. So if price didn't break any structure, then it's unlikely. There's no guarantee that price wants to go lower, right? You need to think of trading as a game of probability. So if there was no structure break, it is less probable for price to want to go lower because no structure was taken out. In this case, right, with this move down, you see structure points were in fact taken. So it is more likely for price to go lower. It had clear displacement. It had a clear fair value gap. Price tapped into it. But once again, our trading windows from 9:30 to 11. This didn't happen in between that range. It happened. The trade would have activated at 11:03, which is after our window, so we didn't trade, and we wouldn't have traded this day, and it protected us from losses. Right? There's gonna be some traders who would have that as a rule and break the rule because they see an opportunity forming, and it will result in a loss. This is why you need to follow your rules and follow your strategy. Same idea here. Previously, I was waiting for any sort of for liquidity grab, and then I would enter on a fair value gap when there's no structure break. And as you can see, this would have resulted in another unnecessary loss, right? So the rules that I have with the strategy are put there to ensure that you succeed, to avoid unnecessary losses, to avoid um yeah, taking less probability setups. Like at the end of the day, you want to be very selective because you want to trade when price is giving you exactly what you're looking for, and that is what's going to allow you to succeed in this market and only take the most optimal setups that present themselves. So that pretty much wraps up the video. If you enjoyed the video, do leave a like and subscribe as we're on the road to 1 million subscriber, guys. So once again, it's Joel, and I'm out. I'll see you guys for the next video.